A loan can work wonders for you, whether it is for business purposes or for buying a home or for buying a car. These days, most people live on credit cards as well. Debts have in a way become a part of our lives. But not all debt is necessarily bad or disadvantageous to your goals. For many of us, and especially the entrepreneurs, debt is merely a fact of life. What most people don't realize is that when used responsibly, strategic debt is a tool to improve one's long-term financial situation. But what is equally important to note is that if your borrowing gets excessive, it could snowball into a debt trap as well. That's the reason why it is very much important to keep your debts under control by separating the good from bad ones. Hi, I'm Namita. Welcome to IndianMoney.com, and in today's video, we are going to learn about the difference between good and bad debt. There is certainly a saying or an argument per se that no debt is good debt. After all, borrowing and repaying high interest is bad, right? But good debt benefits your financial future, while the bad ones or the bad debt harms it. The distinction between bad and good debt can be made clearer based on what is purchased. At the macro level, governments as well as at the micro level, most households today have debts. So is it really true that no debt is a good debt? Let's explore that and understand what is the difference between good and bad debt and how or what can actually help you to overcome the bad debts. Starting with, we'll first get on to understand what is a good debt. Well, there is a saying that goes like, it takes money to make money. So, good debts are those debts that will pay you dividends in the future. They are basically the investments that you make that will grow in value or it will generate a long-term income. Let me also tell you that low interest debts can also be a good debt. Some of the examples of good debts include your student loan, mortgages, small businesses loan, etc. So how is that possible? Let's understand one by one. So the first one is student loan. So student loans for college education are a very good example of good debt. In general, the more education an individual has, the greater their earning potential. Education also has the positive correlation with the ability to find employment. Better educated workers are more likely to be employed in a good paying jobs, and they tend to have an easier time finding the new ones should the need arise. An investment in college or technical degree can often pay for itself within a first few years of entering the workforce. However, not all degrees are of equal value. So it's very much important that you understand the worth considering both short-term as well as long-term prospects for any field of study that appeals to you. Also, a point to note as to why student loans are considered a good debt is that it offers you tax benefits. So any debt that proves to be an asset for you, or it improves your credit history, or it gives you any kind of tax benefits, then it is often treated as, or it is considered as, good debt. The second one is mortgage. Now, taking out a mortgage to buy a home is also considered or is treated as a good debt. Why is that so? Because when you take a home loan, you are basically investing in an appreciating assets. Home mortgages usually are a long-term loans and you have a lower interest rate when compared to other loans. Also, you need to note that when you're taking out a home loan, you are effectively getting tax benefits under Section 80C and under Section 24 on the principal amount that you pay as well as the interest that you pay towards your home loan. Now, let's take for an example, if you're taking a home loan, let's say against 8% interest rate, and you also fall under that 30% tax bracket, then your interest rate goes down rapidly to 5.6%. Now, giving a mortgage also leaves a room for an individual to invest in other portfolios with lower monthly loan repayments. This is keeping in mind that the value of the mortgage increases over the time in the market. The next one is home equity loans. Now, home equity loans are also considered as one of the good debts on your list because of the lower interest rates that depends on the appraised value of the home. The next one in the list of good debts includes small business loan. Now, the money that you borrow to start your own business can also be considered under the headings of good debt. Being your own boss is often both financially as well as psychologically rewarding. It can also be very hardworking. Like paying for your education, starting your own business comes with considerable risks. Let me also tell you that almost 1/3 of small businesses fail to survive their first 2 years. But if you have enough ambition, you're savvy and luck, borrowing money to start your own business could be the best investment you will ever make. Moving on, let's now understand what are the risks of good debts. Now there is a saying that too much of a good thing is bad. Often people extend their budget to buy a home that they cannot afford. Overstretching your finances could leave little money for meeting your other important financial goals as well as contingency situations. So make sure that you make down payments for at least 20% of your property value and you limit your home borrowings to the minimum. Similarly, while you're taking an education loan, ensure that you research its scope, the job opportunities and the probable career progression. Make sure that you don't borrow more than a year of your expected first year salary. Moving on, we'll now understand what is bad debt. Well, bad debt is when the borrower takes money from the future on something to spend today. Basically the money that is incurred to buy things that lose their value over time and they do not generate any kind of long-term income for you. Bad debt also carry a high rate of interest. Usually when you're taking a credit card to watch a concert is considered as bad debt. The other examples of bad debt includes your payday loans, your credit cards, auto loans, etc. Now bad debts are typically that you take to fulfill your desires. So let's understand what are the examples of bad debts one by one. So the first one is payday loan. Now the cash advance loans or the payday loans require the borrowers to give a fee and the interest that is incurred over time. Also know that failing to pay back the amount by the next payday acquires yet another processing fee. So this is one kind of bad debts on your list. The second one is auto loans. Now, while you might feel like it is quite necessary for you to have a four-wheeler for easy commuting, but borrowing money to buy a car isn't a great idea, especially from a financial perspective. By the time you leave the car lot, the vehicle that you've got already is worth less when compared to at the time when you have bought it. If you need to borrow money to buy a car, for example, then you should look for a loan that comes with low or no interest at all. You will still be investing a large amount of money in depreciating asset, which is car, but at least you won't be paying the interest on it. The next one in the list is clothes and consumable. It's often said that the clothes are worth less than half of what the consumers pay for them. Of course, you definitely need clothes, food and furniture and all kinds of other things, but borrowing to buy them by using the high interest credit card isn't a very good idea of using a debt. Use a credit card for convenience, but make sure that you will be able to pay back in full at the balance at the end of the month to avoid any kind of interest charges. Otherwise, if you cannot afford that, then try to pay in cash. The last one in the list of bad debt is, of course, the credit cards. Now, plastic is not just injurious to our health, but it is also injurious to our financial health as well, and the interest that is incurred on that is a silent killer. So this is another bad debt on your list. So please avoid this. So far we have understood what is the difference between good and bad debt. Now it's time to give you solutions as to how you can become debt free. So there are multiple methods. The first one in the list is adopt a debt payment strategy. Under that, there are two strategies for paying off your debt, which is debt snowball and debt avalanche methods. Now what these methods actually mean or how they work, let's understand that. So the first one is debt snowball. Now under this method, you basically start off by paying your smallest debt first while you're still making the minimum payments on your other debts. And then you will move on to making or paying off the other smallest debt. This will give you a sense of momentum that will build over time, just like a snowball rolling downhill. Or if not this, the other method you can use is other way around. The second one is debt avalanche. Now under this method, you start by paying off the highest interest debt first while you're making the minimum payments on your other debts. And then you start paying off the next highest interest debt. Now with this, you may pay less interest over time by knocking out all the highest interest rate debts first. While the debt avalanche strategy might help you to save money on interest, you might prefer to feel the accomplishment you get from debt snowball method when you pay the smallest debts first. However, whichever ways or whichever method works best for you, the important thing to note here or the result is to become debt free. The next one in the list of how you can become debt free is you need to consider a debt consolidation loan. Now, you might be able to get a better debt on paying off your credit card debt or other debt by combining those debts into one new loan. Now, this basically is called as debt consolidation loan. Now, let me tell you that to get a consolidation loan, you will generally need a very good credit history. Now, similar to a balance transfer card, the best debt consolidation loans offer you a lower annual percentage rate on your debt, helping you to save money on interest and pay off debt faster. Both with the balance transfer card and the personal loans, the challenge is not to incur additional debt while you're paying off the card or the consolidation loan. The last one is automate your debt payments. Now, all these savvy savers automate their savings. If you want to be free from debt, try using these tools and techniques to put your debt payments on autopilot. Now, under this, there are 3 methods or 3 rules you can follow, steps you can follow. So, the first one is you can use automatic transfers from your bank account to your credit card. The next rule or the step you can follow is you can use a calendar or automated reminders to keep a track of payments due dates, especially if you're paying multiple credit cards or debt at once. The last step is you can use debt management app or budgeting app or your bank or credit union's built-in online tools to track your progress with paying off the debts. So these were some of the methods or the steps you can follow in order to become debt-free. I hope through this video you've got a fair understanding of what is a good debt and what is a bad debt. Also, if you're someone who's looking or who's considering to take a home loan or a car loan or an education loan, or if you're someone who want to venture into entrepreneurship journey, you want to start your own business, or if you want to know more about how you can avail business loan, then we have built an in-detail course on these which is available on our Financial Freedom app. So hurry up and download the Financial Freedom app on Play Store or App Store and get access to the knowledge we give you before you take out any kind of loan. Also, before going, do not forget to hit on the like button, subscribe to the channel for more such financial content, and hit on the bell icon to get notified for our next video. Thank you for watching IndianBunny.com. Get wise, break free.